Good afternoon, everyone. So over here on my Robinhood portfolio, and I am just going to show you guys how to use options in Robinhood. Now, just to be clear, options can be extremely amazing, but they can also be extremely devastating. The reason why is because options are a leveraged position. So one option contract basically equals 100 shares of a company. They are either buying, you're basically paying for a contract so that you can buy or sell a company, 100 shares of a company at a certain price on a certain day. So depending on your expiration, the farther out you get, the more expensive the option will be. The closer in, the cheaper it'll be. So just showing you how to buy options on a company, let's say such as Apple. Let's take a look over here at Apple. So Apple right now is trading at 281. They recently had a kind of an interesting day this last Friday because they jumped up a lot pre-market and then they fell really hard. Well, I shouldn't say really hard, but they fell about $10 during the day. We're testing the lows of that day. So we're over here on the Apple page, and I think Apple's going to have a bit of a tough time with earnings season coming up. Usually Apple rallies in earnings, but this season is slightly different. We also saw that with JP Morgan. JP Morgan is in the financial sector, and so usually it rallies in earnings, and usually earnings are never, like, the earning estimate isn't beat very often, but it was this time. So with Apple, I think even though they are such an amazing company, they have such a high market cap, I think they're gonna have a little tough time with the lack of sales and also the recent downgrade. So, for example, if you wanted to say, okay, I think Apple is actually going to fall, well, the first thing you always want to do with options is check when the earnings are. On Robinhood, usually they have a chart down here on the bottom. It tells you April 30th after hours. So right now our date is April 19th. So that means we can buy an option for this week without going to earnings. We don't want to hold options over earnings unless you're very confident that the stock's going to go in your direction. So May 1st would be past earnings, so we don't want to do that. So April 24th. Let's go with April 24th. We think the company is going to go down. So we want to click on buy and buy a put. April 24th. What do we think it's going to go down to? Well, Apple's been moving around a bit. It hit a low of 228 or 218 like a couple weeks ago, but it has rallied since. So what's a realistic movement for Apple? If we get more bad news, it could fall $10, $15, but it's a pretty stable stock. So these options are expensive. It says $2.35 at the 272.5 mark, but that's really $235 contract. I think it'll fall down to about 270 within the next week. But the thing is that if it goes down to 270, we don't break even because we're paying $192 for this contract. It has to go down to 268 for us to break even. So, do I think Apple's can get down to 268? I'm not sure. I really don't know. But if we were going to do this play, we would press continue. It's called long put. And you would press continue. You enter one contract because that's 100 shares. And then you want to make sure your bid-ask spread isn't too wide. Here we only have about a $9 spread. So it's not too bad. Some companies have dollar spreads, which is crazy. So you got to be very careful not to overpay for these options. And this is a weekly contract. So with weekly contracts, what happens? Well, your theta burns you up. This is how much money, how many cents this contract will lose each day. Each share loses each day. So 35 cents per share, or $35 for this contract every day. That basically the stock price doesn't move. So you really got to be proactive. You really hope the stock is proactive with your approach. So it's just a basic, a simple thing to keep in mind with options. I'm not going to do this play. It's just for an example, basically, of like what you could do for plays. My plays right now, I've been a little more on the conservative side. As I mentioned in my last video, I have Disney calls and Apple calls, but these just aren't calls. These are called credit spreads. So credit spreads are unique because you're not taking too much of risk. Your risk is limited. Whereas with other options, just buying a naked option or just buying an option in general, if that stock doesn't go to that price, you lose your whole investment. With these, you're selling premium. So you're buying, you're selling the right to sell 100 shares to somebody else for 111, but you're also buying the one right above it. So then basically your cost basis is cheaper So if I was going to sell this call, which I already did, and I bought the one above it, I would get 24-cent credit, or $24 credit basically. If the stock of Disney doesn't go above 111 by Friday, I get to keep $24, and that's it. It's super simple. This is a little bit more of a it's closer to in the money play than I usually like, but I usually go really far out of the money. As you can see, I bet against Apple as well. 290, 292.5 call credit spread. I get 66 cents for this, so $66 to sell the 290 call and buy the 292. My risk is $250 for a $66 gain, which is a very good percentage return if Apple does not go above 290. So because of the reasons I discussed earlier, I don't think Apple will go above 290, but instead of buying a put, I'm limiting my risk, my downside, by buying a call credit spread, because I can also buy this back if it doesn't go in my direction. So that's just a simple idea, simple introduction to some options trading on Robinhood. I hope to do some more in-depth ones soon. If you have any questions, please let me know, or any ideas for a future video, please let me know, and I will be happy to take a look at those and do my best to help explain it to you. Thank you, and I look forward to talking to you guys soon.